Hello, everyone, and welcome to this episode of the podcast. So we have our resident genius, Ralph Hebgen, the super genius, super special everything person who knows everything about everything. And this week, we're going to be talking about one of the stories that I mentioned in it's called Watson's Daily. And I thought it was an absolute corker of a story. I just thought we'd talk about something other than the obvious thing that we talk about all the time this week. So we're going to talk about the Bank of America recommendation that went wrong. So the bare bones of the story are that Bank of America wrote published a piece of research which basically had a list of 17 European financial, companies on this list, and they said basically sell those on the list because they are exposed to private credit. Now, private credit is a very boring sounding topic, but very hot topic at the moment because there are worries that too much exposure to private credit will mean that it will actually leak into the traditional banking sector, because banks lend to the private credit companies, and if things go wrong with private credit companies, then that therefore means that the banks get affected, and that means we get affected. So there's been loads of comments about that, so it's very topical. I can imagine that the research departments of these places will have talked about what should we publish, and someone would have put their hand up and said, well, I think private credit, great idea, let's do it, let's get everyone working on it. And I think I can really imagine that happening. I can also imagine that this. I'm doing a lot of imagining here, but I can also imagine that when this report was published, that sales teams were thinking, brilliant, this is great. Like, this is this is a topic everyone wants to know about. It's got some names on there that we can actually do something, sell. We can do something with. Great, let's go out. And then shortly after publication, the Bank of America said, actually, no, we're withdrawing this now. And in fact, it's not. This is factually inaccurate, which is just an absolute shocker, because you really don't want to be publishing stuff that isn't factually correct. And for a bank like that to do it is a pretty big boo-boo, I think is the technical term for it. Now, the thing is that Ralph is obviously an expert in this, because he is an ex-analyst, and so he knows a lot about what happens here. So I think it would be very useful for all of us to hear what Ralph has to say about this, and whether there is more to it than meets the eye.
Okay, well, I know nothing about this. Can we talk about something else, please?
Yeah.
You just walked into this one, didn't you, mate?
Yeah, of course.
Okay, cool. Well, I mean, the first thing which I do have to say, however, is that it is true. We do not know anything about what is going on here. We haven't seen the report, nor will we ever be able to, because it's been withdrawn. You can see I'm laughing about this. I find all this reasonably amusing. So it's been withdrawn. We can't see the report, so we don't know what's in it. But sitting on the outside looking in, so to speak, as you said, you have done a lot of imagining earlier, and I will do a lot of speculating now.
Brilliant.
But there are certainly lots of aspects to this story which we can talk about or speculate about.
Yeah.
The first thing I think we need to do just is create a level playing field again, as we sometimes do, just to explain some of the things which are going on here. So private credit is something I'm not particularly familiar with, but I don't think it's any more complicated than saying that this is a sort of counterparty credit loan business. It is called private credit because it's individual companies lending to other individual companies, business to business, in loans which are specifically as a one-off negotiated. And so these things are not like commercial loans in a commercial loan book of a large commercial bank. These are specialized or specifically negotiated single instruments. Then these instruments get pooled in funds by those who invest in them, but the primary thing is the private credit. That is what that basically is. The second thing I wanted to just make clear is that oh no, I forgot this. No, it doesn't matter. That's the most important first point to make.
Yep.
Now, then the next thing, let's unravel slightly who the actors are here. So there are companies who are the primary companies, which are the actual companies who issue the loans, who lend to the counterparties. Then, of course, you have, these are companies themselves, and to the extent that they themselves are quoted on a stock exchange, investors can invest in these companies by buying the shares of these companies. And the second level is to note that the individual credit instruments, the loans, they can get pooled, but in particular, fund managers offer mutual funds. Each of them might have a very specialized mandate. We all know this. I mean, you can invest in tech funds, which have a mandate to invest in the tech industry. You can invest in special situation funds, which have a mandate in maybe investing in distressed companies. And so you can also invest in private credit funds, which have a mandate to invest in private credit lenders. And so that's basically the playing field. These are the actors. Actually, there are a few more actors, because also now we have banks who issue these loans. Excuse me. And we have large banking groups who might have specialized lenders of this ilk in their group portfolio. These might include all the known names we know about, Deutsche Bank, for example, or anybody else, Credit Suisse, etc., UBS, etc. Next up, we have insurance companies who also might have in their portfolio small banks who issue these loans. But the insurance companies might also be investors in these companies, or indeed investors in these funds, or they might run themselves fund management companies who have funds with this specialized mandate. I hope I didn't confuse everybody, but if you guys are going away from my little spiel here by saying, oh wow, this is basically very complicated, then that's basically the message I wish to leave you with.
Nice. Yeah.
There is a complicated meshing, like you always find in the financial services industry, of people who issue the loans, people who invest in the companies who make the loans, fund managers who pool all of these investments into specialized funds, insurance companies who either invest in them or run the funds themselves, and large banking groups who own these companies who make these loans. And this is, of course, why Bank of America might have seen it as a commercial opportunity to issue a sector note, a general research paper, which talks about the sector of of private credit in general. Like I said, we can't read the research note. We haven't got it. It's been withdrawn. But what we can find in the press is the list of companies which apparently Bank of America recommended to sell. And I'm not reading out the entire list to you, but from memory, there was the Partners Group was on it, some fund managers, and some banks like Deutsche Bank, which I mentioned, and a list of insurance companies, many of them UK-based, Legals and General, Aviva was on the list, and amongst the Europeans there was AXA, Generali, and Allianz, I believe, perhaps as well. So this is why I initiated my little talk with the elucidation of the playing field here, because insurance companies were on this list of Bank of America. In fact, looking at the list, most of the companies on it were insurance companies. So that's basically the situation. And now, why is it news? Well, it's news because, as you said, Peter, Bank of America issued this report, which had a sell recommendation on most of, you would guess on this particular list of companies. And then a day later or 2 days later, it was withdrawn. It was withdrawn, allegedly, I read in the press, because of factual inaccuracies. You can see Peter smiling for those who are watching this. And Peter, of course, is an ex-salesman and I'm an ex-analyst. And so the cynicism bells start ringing when we hear something like this, factual inaccuracies. What we hear is basically conflict with the client base of the bank itself.
Yeah. Cover up is another. Cover up is another sort of phrase that comes to mind, I can imagine anyone who is on that list, phoning into whoever their person is at Bank of America, saying, "I say, old chap,
yeah,
what's all this about a negative spin on our business? I really wish you wouldn't do this because it's not very nice." Something like that, I can imagine, would have been said.
It is possible. I mean, I'm sort of playing this in my mind, in my light-hearted commentary. It just goes a bit like this. Ralph goes into the room and the CEO says, "Ralph, you can't issue this. There's a factual inaccuracy." "Oh, yeah? What is that then?" "Well, it says sell on it."
Yeah.
Well, that's not wrong, is it? Well, no, it is in this case because the company you're selling is unfortunately a company who is our client. And that makes it factually inaccurate. So, well, obviously, I'm inventing this here, and this is not how this actually really works. But there are, of course, conflicts of interest in the corporate sector there, which might have played into the withdrawal of the report. There is another funny aspect because Bank of America is, of course, also active in the field of private credit itself. So, in a sense, implicitly, if you are having a sector note, a table-pounding sector note, sell the private credit sector, then in a sense you're saying, well, we are also playing in this field. So the sales force go on the phone and they say, "Sell us, we're crap."
Yeah. I think, well, actually, do you know, I was just thinking, given your expertise, I think it'd be really good to explain to listeners or viewers, how is it supposed to work? Like, if let's say that you were tasked with, let's say you're head of the team, you are tasked with writing a sector note about a thematic sector note along the same sort of lines. What is supposed to happen? What is the procedure for this to happen? Because I think most people don't know how it's written. They just assume that you'll sit there and go, right, let's write something. You sit down, you write it, and then you publish it. But that's not how it works. How does it actually work, Ralph?
Well, in brief, I mean, this could be a very long talk, so I'll make it brief. I mean, in brief, it's sort of a little bit of what you just said. I mean, basically, first of all, because it is a sector note, it is not one particular analyst who would lead this, and somebody would need to have the commercial idea in the first place. So we're looking out into the world, we're seeing that the direct the private what was this stuff called? Oh, I keep forgetting. Private lending, isn't it? No, private credit. There we are.
Yeah.
We see that the private credit sector is under pressure, and we are now thinking, oh, well, actually, why don't we get together and write a note which is basically selling the private credit sector?
Mm-hmm.
Which is jargon for saying that most of the companies in the private credit sector will be exposed to downward pressure in their share prices. And so why don't we not do a concerted sector note where we look at the entire sector, where we explain why the sector is under pressure or why there are headwinds. And then we're looking at the companies who are trading in this sector, and we are identifying to which extent, if indeed any, every individual company is exposed to the systemic risks that we identify.
Yeah.
And then we invent some quantification system, or I'm actually really serious now. Invent means that analysts are creative. You need to understand how to analyze this. This is not something which you learn at business school. This is not a standard thing. You need to understand how the risk manifests in each company, and then you need to develop, I should have said, rather than invent. I'm always self-deprecating. One needs to take some of what I say with a pinch of salt.
Yeah.
You need to develop a rating system, and then you need to basically rank all the companies which do business in this sector by order of severity of exposure to the negative systemic risks which you have identified in the note. Then you rank them, and that is the list. That's the list we're talking about here.
Yeah. Yeah.
And then this is basically it. The person who would be driving it is probably your team leader.
Yeah.
If you're writing, in my case, an insurance sector note. In this particular case, it appears to have been a financial services general sector note. So there would have been the team leader of the insurance team, the team leader of the banking team, and one assumes the team leader of the asset managers or miscellaneous financials, as they are called, all coming together and presiding over, coordinating the concerted effort. And so this would have been a big piece for Bank of America to produce, because all the individual analysts, of course, then will need to chime into this and do things, and it can't be haphazard either. You can't just basically say, "Oh, Ralph, write me one page, and Peter, write another page," and we just stick it together, and out the door it goes. It has to be a concerted piece, has to be polished, it has to be generic, and etc. So that's a big thing, and it will have been a reasonable investment of time. I would guess that something like this will take certainly a week, maybe 2 weeks to produce, because of course all the analysts have other things to do as well. You're not working on this full time.
You're literally.
Let me just say one last thing. And because it is a reasonable investment of your time, you will then want to make sure that you reap the credit for it, that you get the benefit. And it is therefore doubly surprising that it was recalled on the next day. There will have to be substantial pressure inside of Bank of America to withdraw a piece into which so much investment of time and money has flown one day after it was published. So sorry, I just wanted to say that as well.
No, that's fair.
Didn't want to cut you off.
Yeah. So I mean, it is a big undertaking. Is the point? And I mean, just out of interest, someone gets the idea. The head of, let's say, the head of the team says, right, okay, team, let's do this. All of you, I want you to, say of all your coverage, what are the exposures, individual exposures, who's most exposed, who's least exposed. We'll put it all together, write a theme. Then presumably that goes to editing. They have a look at it. Does it go to corporate? I mean, it's not supposed to, is it? But I mean, do they cast their eyes over it?
My knowledge of the sector is now getting a bit old, but when I started with you, then these type of notes would be sent to the investor relations teams of the companies in question. And the IR teams, they would look through it and over it, and they would then get back to you. And their mandate, however, always would have been just to point out factual errors. But of course, in the real world, it is not exactly, it's elastic. It's not exactly always clear what the factual error is. I mean, the factual error is if I spell the name of the CEO wrong. That's a clear factual error.
Yeah.
But if I say company X has a 10% exposure to sector X or to sector Y, well, maybe it's 15%, maybe it's 20%, maybe it can't be analyzed, maybe it's unclear. And for a company then to say, you said 10%, this is by far too high. This sounds like it is correcting a factual error. But it also could be pressurizing the analyst in withdrawing the note or making it nicer or something. And because of that, because of this gray zone, this practice was stopped by the regulator. And when I left the field 5 years ago, you could not do that anymore. You couldn't actually send the note to a company for commentary. What you could do and did do, of course, in the process of developing the note, you would call the investor relations team and you would be constantly talking to the company. But one needs to understand this properly. I mean, a professional analyst who understands their mandate to their clients would do this in the spirit of avoiding factual errors and also creating the right judgment. And here is where I would now say also that I have seen sector notes in my time which were issued by maybe more trading orientated banks in the city, which I would have thought were shoddy. I have one in mind, which of course I'm not going to mention any names here, but on the title page I could see the error. And it was one of these things. They had a sector cell on it as well.
Yeah.
And they had a list there. It was very similar to what might have transpired here. And if companies had called, if the companies that note was recommending to sell had called that investment bank saying, look, you made a factual error, then they would have been correct, because I could see that straight off.
Yeah.
And so that was dodgy, because it was there the motivation to trade in the stocks, I think, dominated the responsibility to be a, let's say, proper custodian of the data and the analysis. So I'm getting to the point where we were both smiling, cynically saying, yeah, factual inaccuracy, we know what that means. Well, let's be a little bit cautious. Maybe we do not know what that means. Maybe it was, in fact, a factual inaccuracy. And allow me to say one thing on this. This is going to be technical, and I'm going to say it anyway. The list of companies referenced here by Bank of America, most of them were insurance companies. And there is the following dynamic which I would like to elucidate is this. An insurance company will not make these loans themselves. They are insurers. They are not banks. They are not regulated to do this. Yes, it is possible. In fact, AXA, I think, has a small bank in Belgium called AXA Bank. It wasn't even on the balance sheet. I mean, it was on the balance sheet, but you couldn't see it basically on the balance sheet because it was so small. It just didn't matter. I mean, this is just my memory from the time that I analyzed AXA several years ago. So it is possible that somewhere within the vast portfolio of companies which make up these groups of insurance companies, there are banks who might have made some of these loans, but it is unlikely that these were large. So an insurance company could, in theory, be exposed to this sector not through lending themselves, but through investing in these companies, or to the extent that they themselves have an asset manager in their group, and that is likely to be the case, run specialized funds which have a mandate to invest in this sector. Which therefore means that for an insurance company, the risk is on the asset side. It is not on the liability side, as it would be for a bank. And this is important because Bank of America here issued a note to its clients, which are investors in companies. So they're recommending to sell a company when they think the share price of that company would be at risk of coming down. It is only the pure asset risk which goes into the share price. This is the technical point. To the extent that insurance companies are life insurance companies, they share the risk on the asset side with a policyholder. This is, you just have to sort of believe me that this is the case. And the sharing gate is very high. It can be as much as 90%. So if an asset loses 100, let's say, in value on the asset side, 90 of that value loss is in the reserves, and it's only 10 of it which goes through to the equity of the insurance company. It's not even the 10 because you have to tax it. So now it's 7. You can see how this dwindles. And it's only the 7 which goes into the shareholders' funds and therefore will find a reflection in the reduction of the share price. Most of the companies in Bank of America's list are insurance companies, and most of them are life insurance companies. So it is not, I'm not saying anything here. I haven't seen the note, and I would actually think that Bank of America analysts are proper professionals and know what they're talking about. But it is possible that just potentially that someone might have slipped up and that some might have identified, let's invent something, 20% exposure of the assets to this sector, and just basically said, well, this means that the share price of the company is exposed to potentially 20% downside. That would be wrong because it's not 20%, it's less than 10% of that. So it's 2%, and you tax it, it becomes single digit. I'm not suggesting that this is what happened, but I have seen slip-ups of analysts before they published their papers, analysts who I kind of advised as associates, who would almost have fallen into this trap. And if indeed something like this would have happened, the insurance companies would have been well in their rights to say, look, this is complete debacle. I mean, you're basically creating the impression that we have a exposure which doesn't exist in reality. But again, the caveat, which I'm going to repeat ad nauseum, haven't seen the note, don't know what's happened here, don't even believe it is likely that Bank of America analysts would slip up in this way. All I'm saying is that we cannot completely discard the notion that factual inaccuracies might have crept into the note.
Well, there we go. I mean, the factual accuracy of this podcast is that we've just come to the end of it.
Well, is that right? What a shame. I just got going.
Yeah. So anyway, very interesting. I just thought it'd be good to talk about this, given obviously it's unusual to see, very unusual to see something quite at this scale. But also the fact that you have such, direct experience of how it actually works in practice. So,
Well,
yeah.
I just wanted to also say I have seen very few incidents where companies would exert active pressure on the analyst to change their recommendation because of, not because of factual inaccuracies, just because they didn't like the recommendation.
Mm-hmm.
It has never happened to me personally. I know of colleagues to whom apparently it has happened, but again, I'm not they, so I don't know exactly what happened there. It is not unheard of, but it is very rare. I've been an analyst for 20 years, and it's very rare. So I would not really necessarily expect companies to complain just simply because they don't like the recommendation. Also, regulations have moved on and the sector is very highly professional. I can almost think that you can rule out for companies just to call up Bank of America and saying, look, we don't like the recommendation, withdraw the note. I don't think that's going to happen necessarily. Why the note was withdrawn, who knows? It is, of course, the case that in the corporate world of Wall Street and the City of London, you do have corporate pressures and conflicts of interest, but we'll never know. Even if we had seen the note, we wouldn't know.
I mean, for sure, certainly not. That's not supposed to happen anyway. But anyway, right. Well, look, I'm going to have to say thank you very much indeed. Thank you very much for listeners for listening, watchers for watching, and we will be back again soon. So thank you very much indeed.
Excellent. Thank you, guys. Thanks for having me as always. Thank you.
Bye.